Hi, it's Dustin back again here with Dustin's Dollars. Today I am going to give you my first impressions on AITX as an investment. Not really give you, just give you my opinion, right? Not financial advice. Um, but this is a Knightscope competitor, also in the security robots space. So I thought it'd be of interest to folks who've been, following along with my recent videos. Before I get into it, let me remind you, I am not a financial advisor, not a financial professional of any sort. Nothing in this video is intended to be financial advice. Everything that I say could be wrong, and you don't know. You need to do your own research. I'm not affiliated with AITX. I'm not affiliated with Knightscope. Um, yeah, I'm not really everything in here that is an opinion. It's my own opinion, right? And I should also mention, in the interest of full disclosure, I do have a long position in Knightscope, right? I hold Knightscope preferred shares that I bought a couple years ago, so I do have a little bit of a bias in this. So take everything I say with a grain of salt, I guess. So getting into it, I've had a number of comments on my videos, and I've seen in other places, around the web where folks talk about Knightscope, mentioning AITX. And I know there's a number of people who like AITX better. And so I wanted to look into it for myself. I've had looked into I had looked into them just briefly when I was doing my research on Knightscope. I did a little bit of competitive analysis. Except I actually didn't find AITX. I didn't realize that was the company. It was RAD, the RID. And I think they were also, I think at some point they were also involved when I was reading a little bit in the history with, what was it, SMP? Another company that did some robotics stuff. So I've had only tangentially looked at them in the past, not as a deep dive and not as a potential investment. And I've just started my research and want to share kind of what I saw right now because, like, I will go a little bit further because I've gotten a number of comments because I'm out here publicly talking about Knightscope. So I think it's important for me to have a more a deeper understanding of the competitors and a fully formed you know opinion for myself of this. But my initial impressions, if it weren't for me making these videos and I was only evaluating this for myself as an investment, from the couple of hours that I've looked into it, I would be gone. I would not be evaluating it further, and that's because when I look at this company, it's not very pretty. And when I say it's not very pretty, it's I understand. I'm gonna go through this, right? But effectively, to me it looks like they're heading towards bankruptcy. And again, this is where I'm gonna throw my not throw my hands up, but give you again the whole disclaimer. I'm just an individual investor. I'm not a financial professional, not an analyst, professional analyst, and there's a lot going on with this company in terms of its financing and the balance sheet. It's actually, honestly, it's a lot harder to understand, than Knightscope. I mean, even Knightscope's fairly complicated with their different classes of shares, but I was at least able to follow along with that one. With AITX, with the bit of research that I've done, there's a lot going on there. So real quick, sort of getting into it with the backdrop here. As I said, AITX is a company. Here, I'll start with this. Here's their website. They also have these autonomous robots. They have some of these. You can see that Scott, that one there on the left, looks kind of like just a tower robot. I think it's similar to the Knightscope K1, and I'm similar in the sense that it's a stationary robot. I think sort of stands up and has a camera there, and has some other capabilities. They also have I think that one, the Rosa there maybe is, I'm not 100% sure. One of them is a wall mounted that I saw, and they have others. They have I think more varied products than what Knightscope has, right? So that's pretty interesting. But they're clearly in the same space, and you can see that Romeo right there, the one on the right side that's moving. I don't know how to make it stop moving. Hopefully that's coming through on the video. All right, but that's I think that's kind of a competitor to the K5, right? I think that's intended to be something that would follow or patrol an area, have some sort of security alerts, those sorts of things. And so they are, I think, a direct competitor in that sense to Knightscope. So that's sort of what the company is. They, I think, have been publicly traded for some time. If I max out the chart here, it goes all the way back to June of 2011. I don't think that's the same company. I think maybe at some point they did a merger or something. I haven't quite teased that out yet, but it's at least been AITX for the past year. And you can see this chart here. I'll see if I can make it a little a little bigger so you can see this whole thing here. If I go just for back to 1 year, right, it looks like the stock was trading up at maybe a peak of 26 cents, which is interesting. But then it's kind of gone down since then. There's another spike maybe in April up to 11 cents, but it's been on this path down, 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 down. And it currently trades at just under 2 cents. That's where it closed on February 4th, on Friday. I assume that was Friday. So it's, it's not a pretty chart, and it certainly makes you wonder, right? Why is it now worth 90% less, maybe less than, it's less than 10% of its value that it was a year ago, which is, pretty concerning, right? Knightscope, just not to, get too fine of a comparison on it, right? But Knightscope has been flat more or less for a couple of years. Maybe it has gone up a bit. They raised $8. Well, just in the past year, you can imagine, right? The valuation has been about flat at about $10. Not the valuation, the share price at about $10 per share, right? Since I think they did that for their raise in earlier 2021, and then now the raise at the end of 2021, and where it's trading out at about $9 now that we're listed, at least as of the moment, right? That's going crazy up and down. So we'll see. But this is at least an interesting trajectory for the stock. Now, getting into what I actually saw for the company, right? The fundamentals here. I'm going to start with the balance sheet, and that's basically all I'm going to be focused on today. Mostly the balance sheet and a little bit of revenues, the income statement. And again, these are just my initial impressions. Let me give that preface before I go too far in here, right? I have started my research. I do intend to do more, and I will present more in the future. Maybe not immediately, because it's going to take me some time to get through all of this. There's a lot going on. But today, I'm talking about what I initially saw that made me pretty skeptical of it as an investment. Forget about the products and the company. I have no opinion on those right now. Maybe the robots are great, and maybe that's going to save the company. But when I'm looking at the balance sheet here, it does not paint a very pretty picture, right? So let's go ahead and go through this real quick. They have $4 million of cash on the books. That might be too small for you to read. About $4 million of cash, which is fine, is what it is. And a couple other things there. Total assets $7 million. But here's where it gets pretty nasty, right? So liabilities, their accounts payable, was half their cash, which maybe that's okay. The total current liabilities, right? They also have in the current portion of their loans payable, which I think, if I understand correctly, and again, I am not an accountant, I think that is what they have to pay in this next year. Not necessarily in the next quarter, but in the next year is, rounded off to $3.6 million there, right? That's almost all the cash they have had on hand at the end of the quarter, right? And this is as of November 30th, 2021. So that's pretty concerning, right? Almost all of a sudden you can see right there, cash on hand is almost matched up with their current liabilities, right? Because they also have this loan payable here for $100K. They have current portion of accrued interest payable, $875K, right? So you add all those up, that's actually more than their current cash on hand. And according to this, right, summing up, their total current liabilities is $7.4 million. Versus this $4 million in cash. And granted, you should include the receivables here. And so if you really wanted to match it up, I would include the receivables. Personally, prepaid expenses, maybe some of that is offset and is legitimate. Device parts inventory is not something they're going to be able to use to pay any of their bills, I assume. So, and unless it's a liquidation scenario, which you don't want as a, stockholder, as a shareholder. So, they do have $7 million of current assets, it says, but I would currently would remove this 1.3 million in value here, because that's not going to be money you're going to have. You compare that to 7.4 million in current liabilities. That is not a very pretty picture, right? That screams out to me they need to raise money now. to stay solvent. And going even further on their non-current liabilities, right? This is the stuff they're gonna have to pay after the current year. Yeah, they have their lease, $1 million. That's maybe that seems okay. But the loans payable, right? Here's the kicker, right? $13 million. Then they have this $2.5 million in deferred variable payment obligation, and about $1.5 million in accrued interest payable, right? I again, like I said, there's a lot going on with this company and the financing. Some of it's a bit over my head, but I'm doing my best to understand this. But liabilities are liabilities. I guess what I'm saying is I don't completely understand the structure that's of these liabilities, but it seems pretty clear to me from my understanding. Again, could be wrong. Individual investor here, not an analyst professionally, but this is money they're going to have to pay. One way or the other. And I was reading a little bit about this, right? They got some investors and have some, have issued some things that accrue interest, and they have to pay that out, and they're able to defer some of it for some period of time, but then they eventually are going to have to pay it out. And so that, that's a lot of liabilities, right? So this is, total liabilities we're looking at here, $25 million versus their current assets of $7 million, and even some of that current assets is not what you're going to use to pay off your liabilities. And that is not where you want to be as a company that is also, burning cash, right? So let's go down here in terms of your income, right? Let's go back to go down to the income statement here. This is the quarter ended November 30th, 2021, right? So this would, I think this is their Q3 of their fiscal year, right? So they made, let's round it up, right? $400,000 in revenue for the quarter, and about, what's that, 40% of it or so was in cost. So they made profit, right? They made $200,000, $230,000 in gross profit. But then you look at the, their OPEX is $5 million, right? So they actually burnt in the quarter $4.8 million, so they're not even close to profitability at the moment, which again, and I got this, comparison. People are comparing it to Knightscope. I'll be readily admit, Knightscope is not making profit. They have, certainly negative net income at the moment. They are burning cash. However, they are burning the cash, but they are also not accruing interest and don't have the liabilities, right? That's what really scares me away from AITX, at least so far from what I've seen, is that they're not the traditional, startup has been raising money and, burning through that cash and issuing more equity, but on a growth path where they can keep issuing the equity at a, higher valuation. That's the ideal, right? Is that you're able to continue fundraising, but at higher and higher valuations, because the company is at the same time growing exponentially, right? Up and to the right. So that, so you're kind of growing into all of that valuation that you're able to raise at. And this right here is they're burning through tons and tons of cash from their operations at the same time that they are also, the liabilities are stacking up because of all the borrowing that they've done and all the financing, right? That's the scary part for me. And that's what, to me, it seems like they're heading towards bankruptcy, right? And I'm going to talk about this in just a second. They've been diluting like crazy, as far as I could tell. Yeah, so I pulled a whole bunch of, I pulled some numbers from the prior 10Qs and 10Ks, and I put together just a couple charts here. And again, I did my best. I had to copy paste this all, or type it in actually all by hand. So, it's possible I got something wrong. So the revenue over time is right here, right? Quarterly revenues. This is quarter by quarter, right? And so it has been going up, and you can actually see they have these nice spikes, but their highest, if I look at what would be the trailing 12 months, would be these 4 quarters here. Here, I'll even add it up. I can do it in the spreadsheet. Sum of B9 to B12. So in the trailing 12 months, right? The past year that they've reported publicly, they made $1.15 million in revenue. I'll leave that there. Now their margins. This is one thing, and I haven't talked too much about this in Knightscope. That's a topic for a future video. They have negative margins, which is negative gross margins, which is nasty. We'll talk about that in the future. But they have pretty good margins, right? They're above 50% here, which is nice. It's where you want to be for your gross margins, right? That's pretty good. Obviously, you're gonna have all your OpEx after that, but that's good. So those seem okay, right? And again, if it wasn't for the balance sheet, I'd be much more intrigued. And they have had more. This is another thing I just looked at, is how much cash have they had on hand over time, and so this has actually been going up. So you have to wonder, hey, if they're losing money, how's their cash on hand going up over time, right? Usually that means they're financing, right, of some sort, either issuing equity or debt. And yeah, as we saw, they are issuing debt and diluting, it looks like. So I looked at how many common shares they've had outstanding over time, right? And so it looks like this has gone from, what is this? In the middle of 2020, they had, if I can get my digits right, about 600 million shares outstanding. And that number, and this is, again, I copied these over by hand from the 10Qs and the 10Ks, so I could have gotten it a bit wrong. But it looked to me like then they've been diluting like crazy since then. And as of at the end of that filing, there were 4.4 billion shares outstanding. So they have about 8 times, maybe 7 times, somewhere in that vicinity, the amount of shares outstanding that they did a year and 3 months ago, right? Because this is actually as of the end of November. This is as of the end of May. A year and a half. In a year and a half, they have like 6 or 7 times the amount of shares outstanding. That is crazy. That's a lot of dilution. And if I saw correctly, their max authorized shares is 5 billion. So they're rapidly approaching the limit of what they can actually continue issuing. So they're going to hit a hard limit there. Although, granted, another thing that I noticed is it looks like the CEO, it looks like he's a super majority shareholder. I think he holds like 68% of the company. Let's see if I can. No, that's not it. Maybe I got the numbers wrong. You know what? I think it's in the 10K, not the 10Q. Let me see if I can pull that up real quick. It's insider ownership. Yeah, Steve Reinhardt's 67. I rounded up to 68. So he owns apparently these preferreds, Series E preferred stock and Series F preferred stock. If converted, he would receive 10 billion shares of common stock. So that's insane. I shouldn't say that's insane. That's crazy. Why did I say the same thing? It's a lot of shares. That's what I'm trying to say, right? He owns 68% of the company. He can basically do whatever he wants with this thing. So I found that really interesting because it wasn't obvious. It wasn't obvious he owns any shares until I saw this, and it's like, well, apparently he owns these preferreds that are convertible pretty into a whole lot of comments. Yeah. Now the other thing I just want to call out here before I go, because this is another thing that really jumped out at me, is they did this recent issuance, and they have this purchase agreement with this GHS Investments, where they have this agreement where they can basically say, hey, buy some of our stock at various points. Let's see if I can find the no. Why am I not finding it here? Here we go. That's not it. So basically, yeah, they will purchase up to 400 million shares, but the company can send to them a a notice that, hey, we want you to purchase some shares, and then they will buy them. I think they will buy it from the company at a discount, a 15% discount. I think it was 85% of the VWAP, the volume weighted average price over the prior 10 days, if I'm reading it correctly. And how many shares they can have them buy is up to a maximum of a certain number of shares based on what the prior 10 days volume weighted average price was. And so basically they'll buy more if the price is higher, it looks like, if I'm reading this correctly. But they'll buy up to a maximum of 400 million shares. And they did actually say in the 10Q, if I can type subsequent events, did it actually say that they've already had them buy 100 million shares for net proceeds of $1.1 million, right? And so the company is still diluting at this price, right? And so that would be a price of, what's that? 1183825 divided by 100. 1, 2, 3. So they're selling shares to them at 1.1 cents, right? That's even below. Oops, didn't mean for that to happen. Even below the market price, right? For them to, I'm just going back at the past month, when would they have done that? At 1.1 cents. I don't even know. Maybe I'm misunderstanding, but it sure looked to me like they're buying them at a price of 85% of the lowest volume weighted average price over the 10. Oh, I guess maybe it's the 85% of the cheapest day in terms of volume weighted average price. I don't know, but that's the company is literally selling the shares to them at bargain prices, and you can be sure that they're probably turning around and selling that, because it seems like the company, their liabilities are so huge. That seemed like a red flag to me, on top of some of the others, right? Their assets and their liabilities, that was they were continuing to issue shares at that low of a price. So yikes. So anyways, again, let me give the disclaimer. There's a lot going on with this company in terms of financing, but things don't look good from what I saw from my initial research. Let me know in the comments, like what's the bull case, right? That this I haven't looked tons into their products, haven't looked tons into the news of the stuff, but it just seems like maybe it seems like they are growing, and the products, maybe they're good, maybe they're not. I again, I have no opinion on that. But like just the financing, right? Just the balance sheet is looks bad. It looks pretty bad from what I saw. So anyways, that's what I wanted to cover today. Thank you for watching. Have a good one.